All right, let's get right into it. Today, we're putting Circle on the stand. We're going to conduct a full forensic analysis to answer the one question that seems to be on every single investor's mind. You've heard this a million times, right? It's the big, scary story out there, the absolute heart of the bear case against Circle. And the logic, well, it seems pretty straightforward. Circle makes its money from the interest on its reserves. So if the Fed slashes rates, that income stream just disappears. Or does it? So that leads us to the core of our whole investigation today. Will rate cuts actually kill Circle? It's a totally fair question because at first glance, their entire business model looks like it's handcuffed directly to whatever the Federal Reserve decides to do. So let's dig in and actually look at the evidence. Now, Exhibit A for the prosecution, the bear case, comes straight from the source, Circle's own filings. This table shows you exactly how sensitive they are to rate changes. And look at this, a 100 basis point cut, that's just a 1% drop, is projected to slash their reserve income by a jaw-dropping $740 million. Just let that number sink in for a second. We're talking about a nearly $750 million hole blown in their top line from a pretty modest rate cut. When you see a number like that, yeah, the bear case feels pretty darn convincing. It looks like an absolute monster of a headwind. So, case closed, right? The bears win? Well, not so fast. This is where a real forensic analysis gets fun. What if the market has tunnel vision? What if everyone is so hyper-focused on this one scary number that they're missing the bigger picture?
And that brings us to Exhibit A for the defense, $73.7 billion. That's how much USDC was in circulation at the end of Q3. It's a massive, massive number, and it's the foundation that Circle's entire income is built on.
And this chart right here is why that number is such a game changer. Just 1 year ago, that circulation number was $35.5 billion. Today, $73.7 billion. That is not just growth, people. That's an explosion. The asset base has literally more than doubled in just a year.
And here's the punchline. Volume overrides rates. While the bears are freaking out about the rate of income going down, they're completely ignoring that the volume of assets has skyrocketed. I mean, think about it. Earning, say, 4% on $35 billion is a world away from earning 3% on almost $74 billion. This incredible growth in the underlying assets is a powerful defense against lower rates. But believe it or not, that's only half of the bull case. To really get the second part, we have to quickly talk about a line item on their books called distribution and transaction costs. I know it sounds kind of boring, but stick with me, because this is absolutely crucial. Basically, this is the money Circle pays its partners, like Coinbase, as a cut of the income they make from the USDC reserves. So that explosive growth in USDC is one heck of a defense. But it turns out there's another, more subtle weapon in their arsenal, a kind of hidden shock absorber that's built right into the way they do business. So let's go back to that same scary sensitivity table. We all focused on the revenue side, right? That minus $740 million. But look to the right. As that revenue falls, so do their costs. Those distribution and transaction costs we just talked about, they also drop by an estimated $375 million. This is so important. This isn't some accident or a lucky coincidence. It's by design. It's a feature, not a bug. Because Circle shares its income with partners, its biggest costs are variable. So when income goes down, their expenses automatically go down right along with it. It's a natural hedge that cushions almost half the blow from any rate cut. It's brilliant. So when you put all the pieces of evidence together, the bull case is really standing on two incredibly strong pillars. First, you've got that insane volume growth, which just juices the entire asset base. And second, you've got this structural cost hedge, where their expenses just naturally fall with revenue, protecting their profits. Probably the best way to picture this is to think of Circle as a two-engine plane. In a high-rate world, the higher-yield engine is firing on all cylinders, providing all the thrust. But if we enter a low-rate world, well, the other engine, that massive higher-volume engine, kicks into overdrive, helped by the lower costs. This company is actually designed to fly well in totally different economic weather. So, after our forensic analysis, what's the final verdict? Well, that initial fear, while it makes sense on the surface, just kind of crumbles when you look closer. The evidence strongly suggests that Circle is way, way more resilient to rate changes than the market gives it credit for. You might even go so far as to say it's built to be Fed-proof. So you see, this isn't just a simple bet on what the Fed is going to do next.
This is a business that can adapt, one that's riding the much bigger long-term trend of stablecoin adoption. What the analysis really points to is a quality compounder, a company that looks like it's built to win, whether the Fed is hiking or cutting.